So, good morning, good afternoon, and even good evening to some of you. Welcome to the IAA webinar on the importance of climate-related risk to actuaries. Next slide. Next slide. Yes, thanks. Today, our two speakers will be Stuart Wason, lead author of the IAA paper on the importance of climate-related risk to actuaries. Stuart is a member of the Climate Risk Task Force of the IAA and chair of its Insurance Regulation Committee. Stuart is accompanied by Nick Dexter, co-author of the paper, member of the Climate Risk Task Force, and vice chair of the Insurance Regulation Committee. I myself, my name is Micheline Dion, and I'm chair of the Climate Task Force and your moderator today. Next slide, please. The paper presented today is part of the IAA Climate Risk Initiative. The initiative was approved in May earlier this year. The idea was to increase the actuaries' awareness of climate-related risk. As actuaries, we are a risk expert, and climate changes directly impact many aspects of our work. This paper is the first of a series of papers. Other papers will follow. We have one on preparation with climate scenarios. It will be an introductory paper. We have another one that is just starting to be written to address issues specifically linked to risk in an insurance and pension environment. Next slide. Next slide, please. In the coming years, we will also intend to write papers on different topics, namely the application of scenarios to asset portfolios, one on risk management, reporting and disclosure, another one on transition, adaptation, and mitigation, and finally, we will look at global applications to social security issues. Next slide. I would like to recognize all the co-authors of this paper presented today. In addition to Stuart and Nick, I would like to thank Tim Ferlin, Dr. Tatjana Michkovic, and Philip Scheer for their generous volunteer participation to this paper. And now, let's start our program. Stuart, the mic is yours.
Thanks very much, Micheline, and welcome to each of you who have joined us today for this webinar presenting the IAA paper on the importance of climate-related risks for actuaries. So let's begin with a summary of the paper. As key architects of insurance and pension systems, both public and private, actuaries have long played vital roles in managing the uncertainties of financial risk. With the growing global recognition of the importance of climate-related risks, it is natural that actuaries are involved in balancing the rapidly evolving requirements and expectations of all stakeholders, including those benefiting from or reliant on the work of actuaries, such as clients, communities, governments, employees, regulators, boards, shareholders, and investors. The messages in this paper are intended not only for actuaries, but for relevant stakeholders as well. Climate-related risks arise when various climate-related impacts, both direct and indirect, alter or affect the physical resources or assets of individuals or entities. When they also interact with various socio-economic systems, they may disrupt the mechanisms traditionally used to maintain financial stability. While the primary focus of this paper is on climate-related risks, actuaries also need to consider the opportunities that may result for their stakeholders. This paper examines the categories of climate-related risks and their importance for actuaries in identifying, measuring, managing, and reporting this type of risk. In so doing, this paper reviews the impact of climate-related risks on actuarial work, summarized under 5 broad categories: actuarial modeling, product management, risk and capital management, investment management, and disclosure. Even in the presence of COVID-19, climate-related risks continue to have major implications for actuarial work. While this paper does not address the issues of COVID-19, some of its implications, such as the high degree of global connectivity and volatility in business and financial markets, are also of importance in considering climate-related risks. This paper concludes with implications and next steps for actuaries. The Climate Risk Task Force of the International Actuarial Association excuse me, hopes this paper will be of assistance to actuaries in considering how climate-related risks affect their work and the wider work of their employer or client and the communities they serve. So this paper, back one slide, thank you. This paper is organized into the following sections as shown on this slide. I'll be covering the first section and then the last 3 sections. Nick Dexter will be covering the middle 5 sections. Okay, thanks. Next slide. The first section of the paper is entitled "Why Actuaries Should Care." Climate-related risks are rising to a global level with impacts on many areas of our society. Even in the presence of COVID-19, climate-related risks continue to have major implications for actuaries. The number and extent of climate-related events such as heat waves, melting sea ice, bushfires, storms. We've got Hurricane Delta impacting the US Gulf Coast today, are making regular news in many areas of the globe, disrupting and damaging both natural ecosystems as well as human life and activity. As a result, business, governments, and society are seeking the best means of managing and mitigating climate-related risks, both financial and non-financial, as well as exploring climate-related opportunities. Next slide. So climate-related risks have been steadily rising in importance as ranked against other types of risks according to the annual global risk reports of the World Economic Forum. On this slide, I have highlighted some results from the 2020 Global Risks Report. Now, this report was published in January 2020 before COVID was declared a pandemic. The rankings shown are not based on science, but expert opinion. Nevertheless, the rankings illustrate the extent to which environmental risks dominate the top risks, both in terms of possible impact and likelihood. Environmental risks have been receiving higher rankings year after year in this annual report. It is interesting that the risk of epidemic was ranked as above average in impact, but below average in terms of likelihood of all the ranked risks. Next slide. As key architects of insurance and pension systems, both public and private, actuaries have long played vital roles in managing the uncertainties of financial risk. It is recognized that actuaries also play important roles in other businesses, such as banks, for example. And while all aspects covered in the paper may not have been considered regarding how actuaries, clients, and employers are impacted by climate-related risks, many of the issues outlined in this paper remain relevant. With the growing global recognition of the importance of climate-related risks and opportunities, it is natural that actuaries are involved in responding to these uncertainties, as well as meeting and balancing the rapidly evolving requirements and expectations of all stakeholders. Indeed, the importance of actuarial involvement in climate-related risks has been noted in a survey of insurance supervisors. Climate-related risks can arise from local conditions, but increasingly, the world is becoming aware of the importance of understanding their wider regional and global impact and implications. Recent climate-related events, such as Hurricane Delta and other types of windstorms, floods, droughts, and forest and bushfires, such as those in California, for example. These events have affected human activity locally and globally through their impact on, for example, vulnerable populations, agricultural production, and all sorts of commercial activity. Climate-related events impact people's belongings, dwellings, physical structures, crops, infrastructure, businesses, etc., and may result in damage and financial loss. These events and longer-term variations in the climate may also affect human health, morbidity, mortality, and longevity, and the value placed on assets by the financial markets. Also, changes in consumer and investor preferences resulting from climate-related risks will also create risks and opportunities, both short-term and in the longer term. Next slide. So, an increased focus on and understanding of climate-related risks and benefits all stakeholders by increasing the transparency with which these risks are addressed by all market participants. The IAA paper provides examples of several important roles that actuaries can play in helping to address climate-related risks. Let me speak directly to some of them. Well, fundamentally, actuaries need to review their underlying models used in their work for their continued suitability in light of climate-related risks, both in the short term and in the long term. Such a review may need to consider a system-wide approach to modeling climate-related risks. Secondly, actuaries need to be involved in investment strategies, asset selection, and product design to support the management of climate-related risks. Thirdly, actuaries need to enable and ensure that their clients work toward improved governance and risk management of this risk. Finally, actuaries need to disclose in their work the impact that climate change has regarding the physical transition and legal or reputation risks according to frameworks such as that of the Task Force on Climate-Related Financial Disclosure, TCFD, of the Financial Stability Board. So, Nick, over to you.
Thank you, Stuart. Good afternoon, everyone, or good morning, or good evening. Well, we typically consider three risk categories. Firstly, there are physical risks resulting from climate change, which can lead to more frequent or more extreme weather events, or they could result in longer-term shifts in climate patterns. They may have financial implications for organisations through direct damage to their assets, or also through indirect impacts from supply chain disruption, for example. Similarly, insurers and pension funds may be exposed to risks both through their asset portfolios and their liabilities, assets might be adversely affected due to the increased costs of climate change adaptation, the impact on economic value of business, or losses from physical damage to assets. For life insurers, their liabilities could be affected by, for example, an increase in the frequency and severity of heat waves, which could lead to an increase in morbidity and mortality. General insurers may be exposed to physical risks through insurer events, for example. There could be increase in the frequency of extreme rainfall and associated flooding, causing damage to property and crops. Or there could be windstorms and flooding events, giving rise to significant pollution and consequential liabilities, especially where industrial sites have been involved. And of course, the impact of these risks will, of course, vary by geographic region and the sensitivity of businesses themselves to loss and damage. Next, we have transition risk. Transitioning to a lower carbon economy may entail extensive policy, technology and market changes to address mitigation and adaptation requirements related to climate change. Depending on the nature and speed and focus of those changes, transition risk may pose varying levels of financial risk to organisations. For example, there could be policy risk impacts from attempts to constrain actions that contribute to the adverse effects of climate change, or policy actions that seek to promote adaptation to climate change. There is technology risk, to the extent that new technology displaces old systems and disrupts some part of the existing economic system. And of course, there will probably be both winners and losers as this takes place. There will be disruption to markets as climate change impacts them in various and complex ways. For example, one of the major ways could be through shifts in supply and demand for certain commodities, products and services, as climate-related risks and opportunities are increasingly taken into account. And then last but not least, we have legal and reputation risks. Recent years have seen a dramatic increase in climate-related claims being sought through the courts, and it's likely the number of these cases will increase. These cases can include the failure of organisations to mitigate the impacts of climate change, the failure to adapt to climate change, and increasingly the insufficiency of disclosure around material financial risks. And for insurers, the costs arising from such litigation could give rise to claims under liability covers. And it is also possible that actuaries advising organisations, such as insurers and pension funds, could be eventually subject to a professional liability risk themselves. And finally, climate change has been identified as a potential source of risk to reputation for businesses in general, and also the reputation of the actuarial profession as a whole could suffer damage if actuaries collectively fail to advise appropriately. Next slide. So let's take a look at actuarial modelling. Well, the first place to start is with data. We rely totally on data. And the development and selection of assumptions frequently begins with consideration of past data and underlying trends. In this instance, it is likely that data is now needed that was not needed previously. Identifying, searching and assessing relevant data is a problem, especially for less developed and developing countries where such data is scarce. And a key challenge is deciding what data is relevant, how to interpret that data, particularly as data collection has been improving over time, so that may distort historical trends. Now, thinking about the assumptions themselves, the changes in climate-related risks between years increases the difficulty and challenge of identifying trends in the data on which we base assumptions, as well as the difficulty in separating climate change effects from natural variations. The impacts of climate change are interrelated, and changes in one area potentially have compounding effects in other areas. We need to consider the appropriate way to allow for ongoing trends and for uncertainty in setting assumptions for future experience. In addition, differences in experience may arise between the losses and damage that affect overall society from those experienced in the population segments that are insured. We need to be able to distinguish between those effects in our models. And finally, the impact on how models are structured and how we allow for the potential correlations between risks is important. So talking about models, we do need to consider, as Stuart has said, whether the underlying models used in our work appropriately allow for climate-related risk in the short term as well as in the longer term. A model review may be needed to assess whether a wider system-wide approach to modelling is required than has been used previously. Overall, the breadth and severity of the impacts of climate-related risks have the potential to cause widespread adverse damage to society and the economy, much of which may be difficult to capture in a model in a credible manner. So clearly, a range of possible future scenarios will need to be considered given the different climate pathways that might be experienced. And last but not least, let's talk about the output from models. Given the future uncertainties and the challenges of modelling, the impact of future scenarios, it is really important to explain results carefully, including the key judgments and assumptions, so users can understand the range of potential results, the uncertainties, and the implications. Next slide. I'm just going to talk a bit about the assumptions themselves in a bit more detail because there are various impacts here. So starting with investment, clearly environmental, societal, and social and governance investment strategies, ESG, will inevitably become more widespread and important. So this may have an impact on future investment returns. In addition, future investment returns are likely to be impacted by both physical and transition risks. Investors may divest securities issued by carbon-intensive companies, driving down prices. Or there may be a reduction in future investment returns for investors more generally, so investment assumptions of future experience will need to take this into account. Indeed, some assets may be stranded as their value is eroded due to restrictions on usage as a result of policy changes and other changes. And also the nature and timing of the potential effects will vary by such factors as the nature of each investment, its location and geography, the industrial segment. So all these factors need to be taken into account. Stuart also mentioned that mortality and morbidity could be affected. There are likely to be impacts on the demographic assumptions from climate change. For example, changes in average and extreme temperatures, rainfall, and weather generally may affect crop production and other aspects of agriculture. Water supply may be heavily reduced by drought. These events will likely increase the probability of disease and have a negative impact on life expectancy. The impact of changes in mean temperatures may be beneficial for mortality for conditions related to cold weather, but conditions relating to high temperatures could be exacerbated by their increased likelihood and the increased severity. It's also possible that climate-related risks could increase the prevalence of pandemics or outbreaks of diseases such as malaria, for example, due to a wider spread of disease-carrying insects. And there is a potential for increased exposure to existing diseases as well, as rising global temperatures can lengthen the season and increase the geographic range of disease-carrying insects. Now, obviously, there are some impacts for GI claims assumptions as well. Given that many general insurance products are annually renewable, it may be thought that it will be possible to adjust premium rates each year to reflect the gradually emerging impacts of climate change. But as I mentioned earlier, it can be difficult to identifying underlying trends in changes in the frequency and severity of large catastrophe events. This can make it difficult to determine the appropriate premiums of physical risks, or indeed for determining reinsurance requirements. So actuarial models and the assumptions underlying will probably need to be adapted and developed to recognise that past experience may not be a guide to the future. For example, there's a direct impact from changes in weather-related and liability risks. The decarbonisation of the global economy may create new risks and opportunities for insurers. It's likely that shifts in economic activity, supply chains, business practices and consumer behaviour may impact the underlying exposures. Insurers offering coverage for climate-related liability risks will clearly need to carefully consider their future strategy. And lastly, catastrophe models may not adequately capture climate-related risk, and there may be risks outside the scope of the catastrophe models currently being used. Models may have been developed using historical events, therefore implicitly allowing for in climate change trends in the past, and more explicit allowance will be needed going forward. Next slide. Moving on to product management. Actuarial work needs to balance the needs of those purchasing the products with the needs of the shareholders. We've seen this painted out dramatically over the last few months, certainly in the UK with business interruption insurance, but the same is true of climate-related risks. A fundamental tenet of product development work is that consumers are treated fairly, but that the business is conducted according to sound and sustainable principles. The immediate challenge is to properly design and price products in the light of climate-related risks and the needs of the relevant stakeholders, including both customers and shareholders. This may mean increasing premiums or excluding coverage in areas more susceptible to climate-related risks, such as flooding or wildfires. But whilst limitations in insurance coverage for certain types of climate-related risks may control claims costs, products may fail to meet the needs of customers. This may lead to gaps in protection that are important not only for individuals, but collectively for jurisdictions. The opportunities for successful product management include creating insurance products that align policyholders' financial interests with behaviour that promotes improved client outcomes. This could be achieved, for example, by introducing incentives that encourage policyholders to mitigate or control the risk they're exposed to where they can. Next slide, please. Now, this slide gives an example of how the physical, transitional, or legal and reputation risks can have different impacts on different risk categories. Clearly, the impact will vary with the type of insurance or pension liabilities a firm has and the types of investment held. So this needs to be carefully looked at for each firm. Next slide, please. So thinking about the overall ERM framework, it's important to identify how the climate-related risks fit into this framework. As with other risks, it is important that a board-approved risk appetite is developed specifically in relation to climate-related risks. The risk governance framework and risk management policies will also need to be adapted. Given the constantly changing impact of the various aspects of this risk, it's important both to consider the position now, but also how circumstances might evolve over time. What would trigger a need to review the firm's risk appetite in the future and its risk management strategy, for example? An assessment of the future position is likely to need consideration of a range of different scenarios so that an appropriate risk mitigation strategy can be developed. Next slide, please. Insurers are increasingly required to consider the effect of climate-related risks in their ORSA. This will probably mean extending the future period that is being considered given the long tail nature of these risks. Given the uncertainties involved, this work may need to explore an appropriate range of scenarios covering the varying nature, extent and timing of the impacts. I would at this point note that, as I think Micheline mentioned, the climate-related task force will be considering the design and usage of scenarios in a future papers in this series. Given the potential disruptions involved, firms will probably need to prepare to explore a challenging range of stress tests and loss scenarios to determine the potential impact on their capital and identify the different risk mitigation actions that might be taken. For insurers, this could include considering the need for more or different reinsurance cover. We've seen in the recent COVID discussions how the terms and conditions of the reinsurance have been under scrutiny, so it is likely that they will need to be updated and reviewed. Rating agencies may introduce new climate-related risk measures when evaluating companies' financial ratings. This may affect the ratings of companies, so advisors will need to consider their firm's environmental and climate-related risk profiles to anticipate and potentially avoid sudden downgrades in credit ratings. And lastly, for thinking about defined benefit pension plans, if the sponsoring employer is engaged in activities that are likely to become less popular or less valuable over time, and hence their future profitability, their ability to fund pension obligations may be brought into question. Climate-related risks which do impact the future prospects for the sponsoring employer may also then have an impact on the size and structure of the expected workforce, and so also have impacts on the position of the pension scheme. Next slide, please. I've already mentioned investment management and in terms of the investment assumptions, but the boards of insurers and pension funds want to know how climate-related risks are being allowed for in investment strategies and actively demand change. And this is true for the beneficiaries as well. There is a growing demand for an appropriate allowance for climate-related risks, both in investment and pension fund default options, through the choice of more specialised investment choices. Firms may be faced with questions about whether their investments are in line with the growing public demand for environmentally responsible behaviour and adequately carrying out the fiduciary obligation to consider those risks. Therefore, it's not only a question of financial risks and return, but also a matter of reputation and legal risk. Climate-related risk can be incorporated in an investment portfolio in an ESG or socially responsible investment approach, more actively reducing the carbon footprint of the portfolio or seeking out investments that may benefit from climate-related risks. Part of the actuary's advice may be to help determine the approach that their firm or clients would like to incorporate in their investment policy. But actuaries may also be involved in implementing the investment strategy. In practice, actuaries and other professionals are involved throughout the investment management value chain where climate-related risks are incorporated. Examples include the calculation of quantitative measures for individual securities, such as their carbon footprint and carbon reserves. Developing investment management that incorporates allowance for climate-related risks or quantitatively seeks to reduce climate-related risk scores across their portfolio. Reporting on the climate-related risk exposures in the investment portfolio and the correlation with other investments and risks, as well as developing products that allow for climate-related risk, seek a particular climate-related outcome, or pursue a climate-related theme. Now, there's a growing industry with third parties providing investment data, such as assessing the greenness of certain investments. Given the subjectivity necessarily involved in those assessments, it's important to understand what that third party's approach is and how they have come to their conclusions so that you can properly understand what data you are being given. And finally, it's important that investment mandates are updated and complied with, so it will be interesting to see how ESG considerations impact them going forward. Back to you, Stuart.
Thanks, Nick. As Nick has just mentioned, there is increasing awareness and focus on climate-related risks, both in investment management, but more generally in the financial markets. Given the varied impacts they may have on companies in different countries and sectors, it is not surprising that there has been increasing demand by stakeholders for more extensive disclosure of companies' own assessment of the risks they face, together with the actions they are taking to identify, manage, and mitigate those risks. There are two ways that these types of disclosures are relevant to actuaries. Firstly, actuaries are likely to be asked to support the development and production of the disclosure. And secondly, the disclosures of firms in which those institutions invest will be of interest to actuaries, as they will help them understand the sustainability of those investments. So next slide. And perhaps the most widely recognized and influential document relating to disclosures was published in June 2017 when the Task Force on Climate-Related Financial Disclosures, TCFD, released its final recommendations. They provide a framework for companies and other organizations to develop more effective climate-related financial disclosures through their existing financial reporting processes. Many companies have developed this framework for the purposes of disclosing their exposure and governance of climate-related risks. In reviewing the TCFD report recently, I came across two quotes that I think are quite relevant to today's discussion with you. First quote, "One of the most significant and perhaps most misunderstood risks that organizations face today relates to climate change." End of quote. Second quote, and it's a bit of a long one, but bear with me. "The large scale and long-term nature of the problem makes it uniquely challenging, especially in the context of economic decision-making. Accordingly, many organizations incorrectly perceive the implications of climate change to be long-term, and therefore not necessarily relevant to decisions made today. The potential impacts of climate change on organizations, however, are not only physical and do not manifest only in the long term. End of quote. The TCFD structured its recommendations around 4 key elements: governance, strategy, risk management, and metrics and targets, as illustrated on this slide and further described in our report. Next slide. So this slide provides, I think, a very good picture, a high-level illustration of how actuarial work is exposed to climate-related risks. Beginning on the left side of the slide with observable direct impacts of climate-related risks, storms and floods, etc., as well as their indirect impacts, some of which would be air pollution, water, food supply, etc. When these interact with our various socio-economic systems, the consequences for actuarial work are many and varied, as shown in the last column on this slide and as just described by Nick in his remarks. When considering climate-related risks, it is important to consider all the risks, including those discussed earlier by Nick under transition and legal/reputation risks, as these particular ones may also include step changes in experience in many of the social, economic, regulatory, or legal environments. They may be more highly correlated and have nonlinear impacts than we have observed in the past. Of course, this should come as no surprise to us because of our experience with COVID-19. We have seen this impact directly through the pandemic. Therefore, actuaries need to consider the ways in which climate-related risks may have impacted their past data, models, trends, and outlook for the future. In addition, there's a heightened need to collect high-quality data and develop improved models reflective of system-wide thinking regarding climate-related risks. So next slide. So our IAA paper concludes with suggested next steps for actuarial associations and for individual actuaries. First, some next steps for actuarial associations. One of them is the need for increased research and development into climate-related risks, perhaps through actuarial journals promoting research on climate-related topics, individual articles, etc. Also, actuarial conferences may be a way forward, creating conference sessions or tracks dedicated to climate-related research. And then lastly, partnerships between the academic community and the actuarial profession are also very important in advancing actuarial research on this topic. Secondly, there's a need for training and continuing professional development in the area of climate-related risks. As noted earlier, there is a need for actuaries to familiarize themselves with climate-related risks and have a basic level of training. There is a role for professional actuarial bodies, possibly in conjunction with other professional bodies or academic institutions, to deliver that education and training. And thirdly, there's a need for proactive actuarial involvement in support of regulators and supervisors in addressing issues related to climate-related risks. This is very important, particularly in the financial services sector, where regulators at both the international and local jurisdictional level are tackling these issues themselves. I would note that several actuarial associations around the globe are currently very active in pursuing one or more of these steps that I just described. So next slide. So our paper identifies 8 practical next steps for individual actuaries. While all of them are important, I would note 4 of them for mention during our session today. Firstly, be informed. Climate-related risks affect all practice areas, but in different ways, perhaps. Actuaries have professional obligations to stay up to date with current developments with their professional remit and to be familiar with climate-related risks and their applicability to their areas of actuarial practice. Secondly, learn about climate-related risks and the value of adaptation. For most actuaries, it will be appropriate to have some broad training on techniques for measuring and responding to climate-related risks and adaptation responses relevant to their practice areas. Thirdly, build deeper expertise. Some specific areas affected by climate-related risks require specialized skills such as catastrophe modeling in general insurance, measurement of carbon footprints in pensions and investing, and development of climate-related metrics for actuarial work in general. Practicing in a specialized area requires further training and skills development specific to that area. And the last point I would mention on this slide is start a dialogue. It is important that learning is not done in isolation. Feel free to start a discussion with all your relevant stakeholders to develop an improved understanding of their perspectives on climate-related risks and the demands with which they are faced. Next, I think that concludes our slides. And Micheline, back to you.
Yes, we do have a couple of questions that have come in. So let me go to the questions. The first one is a bit long. It's addressed to Nick because it regards the asset investments. So question is, what discussions are taking place in this forum about the potential long-term real returns on investment portfolios that may be experienced over the next 50 years compared to the last 100 years, to the extent to which past returns have arisen because of economic growth, people plus productivity per head, which will not be reflected in the future, we may have some really nasty conclusions to face up to.
Yeah, no, that's a good question. It's definitely, you know, what I was alluding to in my part of the talk, that we certainly need to do this work. We have a paper coming down the track on the investment side of things specifically, and we will be picking up some of this. So this is definitely work to come. I believe that some of our member associations are doing some work on this, which we'll be trying to leverage that as part of our work on the paper going forward. But yes, no, I certainly agree with the point.
I guess just to complement the answer here from Nick, is this paper is the first of a series. The purpose of this paper is sensitize actuaries, to the importance of looking at climate risk. And then we're building on this with providing information to actuaries. So there's one paper will build on the other, and we are going to go to more and more complex issues. So such as the final one is looking at social securities issues, but that's fairly far down the road, at least a couple of years, I think. So here we're covering everything that basically the actuaries, or if not everything, a lot of things that actuaries can be involved in. But it's basically just touching it, and we're going into more detail with further papers. Second question, it's I guess again to Nick. So to what extent have authors contemplated the accumulation of assets in areas exposed to hazards when thinking about impacts of climate hazards? Risk is a function of hazard, exposure and vulnerability, and are we contemplating the changes in all three components when thinking about changing risk related to changing climate?
Yeah, I mean, this is absolutely right. You know, in terms of actually looking at the losses from current events, you do need to take into account and the trend over time. The fact that you've, as you say, you know, it can be by chance where a particular windstorm hits, and if infrastructure and has accumulated over time in a particular area, you will get a bigger hit. I am aware of a paper that one of the member associations has done on looking at trying to split out the inflation in the cost of events through that sort of analysis. It's not something that we've done ourselves at the moment.
Okay, thank you, Nick. A third question. How can US insurers be further encouraged to tackle climate risk instead of saying that the issue is political and divisive? Any of you want to address that, or?
Well, yeah, I think I'll leave Stuart to give a substantive answer on the work we're doing with other organisations, because I think that, you know, we can encourage our members and the members of our member associations to work in this area. And we certainly have seen some of the insurance commissioners in the US taking a lead in some areas, and in fact 2 or 3 of them are a member of the NGFS, I believe. And but Stuart, do you want to talk about the SIF work that we're doing?
Yes, well, I was just going to say that indeed a number of the state insurance commissions are very active in their climate-related work and involvement with as members of SIF as well. So, I believe the activity is picking up. I think this is the awareness globally is spreading, and that's the reason for our webinar today.
Yes, I would say that generally speaking, we're trying to stay away from the political aspect of things. Basically, talking to actuaries about what's possible out there. It's a question of scenarios. Some may believe in different level of scenarios. And the question is to be able to demonstrate the impact of what if, and without the political aspect of it. So a range of scenarios that will describe the risk without necessarily implying that any of the scenarios would materialize.
Yeah, and I forgot to mention that, of course, the IAIS, it will be publishing its draft adaptation paper on climate risk, which is encouraging insurance supervisors globally to take more steps in regard to this. So we're working with other sister global organisations to push forward the agenda on this.
Micheline, if I might add, there's one reference in the paper that talks about the work of actuaries being referred to by a survey of supervisors, and I just might give a few specifics on that. The reference there was actually to a November 2019 report of the Financial Stability Institute called Turning Up the Heat, Climate Risk Assessment in the Insurance Sector. And that was based on a survey of insurance supervisors. I think there were about 18 insurance authorities that were involved. And in that paper, it referenced the important work of actuaries and that the IAA could support insurance supervisors by providing guidance on how technical professionals can go about undertaking climate-informed risk assessments. And as we've been mentioning a little bit back and forth here on this call today, it is worthy of note to all those listening in that the IAA does engage collaboratively with a number of important international stakeholder organizations, including the Sustainable Insurance Forum, SIF, which is itself a partner organization of the IAIS, International Association of Insurance Supervisors, and then finally the Financial Stability Institute itself.
Okay, let's now go to, we also have another question here, which is a fairly, although said general question regarding climate risk, I think it's a fairly specific one here in terms of not the role of the actuaries, but some of the things happening. So the question is, as CO2 concentration in the atmosphere keeps rising and feedback loops start getting triggered, methane emission from permafrost at high latitude and methane hydrates at the bottom of the ocean, what step can be taken by insurance companies in order to keep climate risk at a manageable state?
It's a very specific and scientific indicator of climate change and evidence of it. I think the science is still evolving. I think the message from our paper is that actuaries have a key role with their clients in letting them know about these types of changes, what impact they may have on the underlying assumptions that are within an insurance business, how products are priced, how they're designed, what trends are coming up in the future, so that they can begin to be discussed within the governance and risk management framework of their clients, whether they be insurers or pension funds. Or any other business. I mentioned banks as well as a possibility. Actuaries are involved frequently in banks and investment schemes as well.
Yeah, and I think that this is clearly a not just an issue for insurance companies to do this. It's a question probably for all investors. I think this is where the development of a suitable mechanism for carbon pricing will come in, and we will. I'm sure that will happen. That investments will be assessed on their greenness or ability to use carbon properly. So I think that I think there's a place for the actuarial profession to be part of that debate and to use the data that is provided as part of that.
Right.
I think this is all the questions we've had.
Yes. This is Christian. There was a question also in chat that I just passed on to you. I can read it out. It says, can climate-related risk also impact disability insurance?
Yes, I think, Nick, this is again for you.
Well, yeah, I mean clearly the weather conditions, and in particular extreme heat and extreme cold, can exacerbate certain medical conditions. And I think that there are a number of key areas around that which are being looked at, as well as the knock-on implications around water. There's a whole topic. In fact, the IAA are publishing a paper around water risk, and contaminated water is one of the biggest contributors to morbidity worldwide. And as the problems with water grows, I was recently did a talk internally at my company about the water risk in the UK, where the authorities are projecting a water shortage in the next 25 years. So if that becomes a rarer commodity or water sources get polluted, then that continue to be a problem. So yeah, there are all sorts of different dynamics that will affect rates of disability and illness, sickness, and so on, and the ability for people to recover.
And we have a note from the person that Martin White, who was the one that asking the question, basically noting to us that a large part of the world population live very close to today's sea level. So thank you, Martin.
Yes, exactly.
Yeah, and to that point, the IAA also published a paper not too long ago on flood risk. So that's also related to that issue.
Yeah, there's so many different.
Yeah. Then there's a few other questions as well that just came in.
Okay, just a second. Let me look at this. So a question here. How do you think about climate projection in our business? Difficult as different groups within profession have different time horizon, but projection for 2050 and 2100 are limited in the way that we're provided currently. So any of you want to tackle this question? I mean,
no, to say that, and I think clearly we'll be touching on this in the upcoming papers around scenarios. But yeah, I agree that it is a problem. I think sometimes it can be seen as a barrier, the fact that it is so uncertain. But we never has it been more true about the saying about actuaries making sense of the future. We have to use our skills to try and use the scenario analysis and to explore what the impacts might be.
And more, I think, depending with the disclosure requirements that are increasing, we'll need to look at longer term horizons, not just the 3-year or the 5-year business projection, but eventually where it's all going and how it affects the long-term objective of the different stakeholders. We do have another question, or somebody mentioned about regarding the disability claim discussion that we just had, that it also affects a lot the mental health.
Absolutely.
Yes,
Oh.
so that's indeed.
We,
A question. Yes.
Certainly agree with that. Yeah.
And then a last question, as we're getting fairly close to the end of this session, being mindful of the time. What are your views on the upward trend in issuing catastrophe bonds and other insurance-linked securities to transfer the weather-related risk to capital market? Do you view the risk as a potential system risk trigger? A potential systemic risk trigger in the near future?
Well, I think one of the issues that's come forward, perhaps it's also partly triggered by the pandemic itself, is the discussion about insurance gaps and what happens in the event of extreme situations. How is the population protected, or are there gaps in vulnerable populations that are occurring? And I think climate-related risks, especially, expose vulnerable populations to risk, to this risk. And so there is a bigger question looming, I believe, for governments, for supervisors, for the insurance industry itself, as just how to deal with any insurance gaps that are arising. What's the best method of looking after those gaps? Does it always fall to the role of governments to fill those gaps? Is there a possible role for insurers, the capital markets, as the questioner was asking? I think increasingly that's a very important line of questioning in which the various stakeholders need to engage.
Yeah, and if I can add to that, I mean, it's so in the UK we are looking forward to the BES, the biennial exploratory stress testing exercise that's going to be done across banks and insurers. Because I think one of the things that we're trying to explore is the systemic risk, because of the interactions between banks and insurers, and just trying to tease out how big the systemic risk might be in this area. So yes, you're right. It's something that needs to be considered.
Well, I guess we're at the end of this presentation. I'd like, as we close, thank Stuart and Nick for their excellent presentation. It's a topic of high interest developing, and you'll hear more and more about it. And I am also inviting you to watch for our next paper on the introduction to scenarios. So again, thanks Stuart, thank Nick, and thank to all the other authors of this paper. And hopefully we'll see you at our next webinar on the next topic on scenarios. Have a great time and stay safe.